Have you ever wondered, while deep in the trenches of managing your business finances, if QuickBooks, that trusty financial sidekick, can actually bridge the gap directly to your bank account? It's a question that pops up surprisingly often, especially for small business owners and freelancers who are constantly juggling invoices, payments, and the ever-present need to keep their cash flow healthy. You're in QuickBooks. You see that perfectly reconciled payment from a client and a thought sparks. Can I just zap this money straight into my bank account from here? So, let's tackle the most common interpretation of the question. Can I take money that a customer paid me through QuickBooks payments and move it to my bank account? QuickBooks Payments, a service integrated within QuickBooks, allows your customers to pay you directly through various methods like credit cards or ACH bank transfers. When a customer pays an invoice through QuickBooks Payments, that money doesn't just sit in a QuickBooks wallet. Instead, it goes through a payment processing pipeline. Just like any other merchant service, QuickBooks Payments processes a transaction and, once cleared, deposits the funds directly into the bank account you have linked to your QuickBooks Payments account. This is a crucial distinction. You're not transferring money from QuickBooks to your bank account in the sense of initiating a push transaction from the software itself. Rather, QuickBooks Payments is acting as the intermediary that facilitates the deposit of your customer's payment into your designated bank account. The process is largely automated once you've set up your QuickBooks Payments account and linked your bank. Here's how it typically works. Customer pays. Your customer pays an invoice online using the payment link provided by QuickBooks. Payment processing. QuickBooks Payments processes a transaction. This involves verifying the payment method, checking for sufficient funds for ACH, and ensuring the transaction is legitimate. Settlement. Once the payment is cleared, the funds are settled. Deposit to your bank. QuickBooks Payments then initiates a direct deposit of the funds into the bank account you have on file for your QuickBooks Payments account. This usually happens within 2 to 5 business days, depending on the payment method and your processing history. So, in this scenario, the answer is a resounding yes. But with the understanding that QuickBooks is facilitating the deposit, not acting as a direct transfer mechanism itself. You don't click a transfer button within QuickBooks to move these funds. The deposit happens automatically as part of the payment processing workflow. Now, let's consider another interpretation. Can I transfer money that's already in my bank account but recorded in QuickBooks to another bank account? This is where the role of QuickBooks as a recording tool becomes even clearer. If you have money in bank account A and you want to move it to bank account B, QuickBooks itself cannot initiate that physical movement of funds. You would need to log into your online banking portal for Bank A or use your bank's mobile app and initiate a transfer from Bank A to Bank B. What QuickBooks does allow you to do, and what is absolutely essential for accurate bookkeeping, is to record that transfer. For example, if you transfer $1,000 from your checking account to your savings account, you would go into QuickBooks and create a transfer transaction. This transaction would debit your checking account balance and credit your savings account balance within QuickBooks, ensuring that your books accurately reflect the movement of funds. This keeps your QuickBooks balances aligned with your actual bank balances, which is critical for reconciliation. Think of it like this. QuickBooks is like the financial map of your business. It shows where all the money is and where it's going. Your bank is the actual transportation system. QuickBooks can tell you to move money from point A to point B on your map, but it's your bank that actually drives the money there. What about transferring money from your business to yourself? This is a common question for sole proprietors and partners. If you're running a business and you want to take out owner's draws or distributions, again, QuickBooks doesn't directly facilitate the transfer of physical cash. You would typically initiate an electronic funds transfer, EFT, from your business bank account to your personal bank account through your bank's online services. Once that transfer is made, you would then record it in QuickBooks. For sole proprietorship, this would typically be categorized as an owner's draw or shareholder distribution in a partnership or corporation. This ensures your financial statements accurately reflect the reduction in equity due to money being taken out of the business. Failing to record these draws would lead to an inflated view of your business's cash position and equity. Another scenario could be related to payroll. If you're running payroll through QuickBooks Payroll, a separate but integrated service, The process is similar to QuickBooks payments. When you process payroll, QuickBooks Payroll calculates wages, taxes, and deductions. It then initiates the direct deposit of net pay into your employees' bank accounts from your business bank account. Again, QuickBooks is facilitating the initiation of the deposit, not acting as the bank itself. The actual transfer of funds happens through the automated clearinghouse, ACH, network, managed by QuickBooks Payroll's banking partners. This distinction is fundamental to understanding how to effectively use QuickBooks for your business. It means that while QuickBooks is powerful for managing your financial data, you still need to interact with your bank for the actual movement of funds. Let's delve a bit deeper into why this distinction exists and why it's a good thing. The separation of duties between accounting software and banking institutions is a cornerstone of financial security and regulatory compliance. Banks are highly regulated entities, subject to stringent rules regarding holding deposits, processing transactions, and preventing fraud. Accounting software, while vital, operates under a different regulatory framework. Combining these functions into one platform would introduce immense complexity and regulatory hurdles. Furthermore, consider the security implications. You would want accounting software whose primary purpose is data management to have direct, unfettered access to initiate transfers from your bank accounts without multiple layers of authentication and security protocols that only banks are equipped to provide. The current model, where QuickBooks integrates with banks and payment processors, allows each entity to focus on its core competency while providing a secure and efficient financial ecosystem for businesses. In essence, while you can't click a button in QuickBooks to transfer money to your bank account in the same way you perform a bank transfer, QuickBooks is absolutely integral to the overall process of getting money from your customers into your bank account via QuickBooks payments, and accurately recording all money movements that occur in and out of your business bank accounts. It's about understanding the ecosystem, not just a single piece of software. Mastering this distinction is key to streamlining your financial operations and maintaining impeccable records. With that said, thanks for watching, and until next time.